Hello everyone, welcome to today's US Open live webinar. It is Tuesday, May the 9th, 10 minutes before Wall Street opens. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. After an explosive past week in terms of events, which ended with another strong jobs report, the new one starts a bit subdued, but things heat up in the second half with high-profile events such as US CPI inflation and the Bank of England. Before we begin with today's session, however, as always, please read carefully the risk warnings and the disclaimers, and then we will get started. Once again, please go over the disclaimers and the risk warnings carefully, and we'll get started in a few seconds. Okay, let's get the ball rolling. As I already mentioned, market seems to tread with caution this week ahead of key releases and events while digesting last week's central bank bleeds and another strong jobs report from the United States. There is also some risk aversion today ahead of talks in the United States around the debt ceiling. We will talk about that a little bit later in the session. Before we get into all of that, let's change things up a little bit today and start with Apple, which we already have on our screens, and its outlook after its encouraging quarterly results late last week. Also, just to a reminder, if there are any questions, thoughts, comments, if you want to share your views with us, you can type your questions on the relevant chat box on your screen. So Apple reported mostly better than expected results, although not particularly impressive. They were a bit underwhelming in my opinion, with total revenue dropping on both yearly and consequential basis. What stood out though was the year-over-year increase in iPhone sales to a record March quarter, having generated more than 51 billion US dollars in revenue. Now, the reason why this is important is because it came as the global smartphone market contracted during the same period, the first quarter of the year, with a 13% decline in shipments, according to research by Canalys. Now, the technology sector in general has made a strong start this year, more due to various cost-cutting efforts, restructuring plans, and all that stuff. And mostly, of course, a Fed slowdown in the pace of tightening and prospects for a pause. Apple gained around 30% during the first 4 months of the year and jumped on Friday. You can see here this highlight candle. It's Friday's gains right after the first trading day, after the quarterly results that I mentioned earlier. It closed above the descending trend line from its all-time highs, and those bring those record highs in its crosshairs, the record highs at around $183. Now, on the other hand, if we look at the bottom of the chart and the relative strength index, it hovers in close to oversold, overbought territory, which can contain the advance. Declines back towards last month lows at around 159.70 would be reasonable. Strong catalyst would be needed for weakness past the 200 period EMAs, which is located a bit lower at around 153. That is it from Apple. Let's go to Nasdaq again. We're taking a different sequence than usually. We start from Apple, we're moving to the Nasdaq, and then we will move over to Euro USD and AUD USD, and we'll round things off with what's ahead. Now, in terms of the tech-heavy index, on Friday, we got another strong jobs report. Robust addition of gains of more than 253K payrolls in April, while the unemployment rate ticked back down to its 5 decades low of 3.4%, only a couple of days after Chair Powell had spoken of an extraordinarily tight market. Now, the index reacted positively, contrary to what usually happens, because strong jobs report mean that the Fed needs to tighten more. That's bad for stock markets. But given that the Fed hinted to a pause last week of its tightening cycle, markets elected to interpret the data as a sign against recession, which is one of the fears going around, given the credit tightening and the banking turmoil and other factors. Of course, it was also helped by encouraging Apple earnings that we just talked about. Now, on the other hand, the Fed may have a hard time shifting gears in terms of monetary policy, since the strong jobs report definitely keeps pressure on, and wages increased last month, which makes effort to bring down inflation even harder. Even in the case of a Fed pause next month, the central bank is unlikely to signal the end of its tightening cycle, and Fed officials have definitely dismissed market expectations for cuts. Of course, now focus shifts to Wednesday's inflation report, which can be critical. Now, in terms of technical analysis, not much has changed. Bulls are in control, with the road open towards 13,742 resistance. Fresh impetus will likely be needed. However, again, as I said, markets may be overly optimistic about the monetary policy landscape, and there is still a risk for a breach of the 200-period EMA at around 12,950, but strong catalyst is required for a test of the broader 12,600 region, which contains a rising daily Ichimoku cloud, and of course the ascending trend line that we see here. Again, if there are any questions or comments, feel free to type them in the chat box so that we can address them. So we're still 1 minute before Wall Street opens. That's pretty much it for Nasdaq as well. So let's move over to FX and Euro USD in particular, which actually slides today around 0.5%, 0.5%, sorry. Now let's take things a step back. The ECB and the Fed continue to drift apart after last week's policy decisions. We talked extensively about the Fed and briefly about the ECB on our last session. The US Central Bank hiked rates but opened the door to a pause of its year-long tightening cycle. Its European counterpart raised rates by the same amount but pointed to more policy firming. President Lagarde stated that we are not pausing. That's very clear. I quote, "We're not pausing," that's very clear, adding that they have more ground to cover. This differential continues to support Euro USD, and technicals are also favorable as long as we stay above the 200-period EMA, which keeps bias on the upside, and chances for new 2023 highs towards 1.1233. However, as we said, the pair slides today and test the EMA 200. So there's material risk of moves below that. The downside is well protected. And although below this EMA here, the pair would be exposed at this critical region of around 1.081, 1.067, this rather broad region. Here, I believe that sustained weakness below these levels, although I can see this level coming, these levels coming into play. I think the current policy differential does not justify sustained weakness below this this level. Now the risk here is that market expectations for rate cuts, even opposed by the Fed, could be disappointed, exactly because of what we talked about: tight labor market and high wages and elevated inflation. So given the fact that on the other side, around the ECB, markets expect rate hikes, any disappointment of that on the Fed part of cuts could weigh on the pair. That's the biggest risk at this stage for the pair. And of course, one of the reasons for today's slide is some risk aversion from that we see, partly due to talks in the US about the debt ceiling. Now let's move to the Aussie against the US dollar. Interesting technicals here. So the pair benefited from the surprise hike by the RBA last week, and then the Fed opened the door to a pause and registered, and as such, the Aussie registered an impressive 6-day profitable streak, but stops at the familiar resistance. We've talked about it again here from this series. We're talking about the 38% Fibonacci of the 2023 high-low drop, which it rejected multiple times in the past month, as you can see in this chart. Now, it comes under pressure today, and there is risk for a test of the 200-period EMA and the lower border of the daily Ichimoku cloud, but daily closes below it would bring the 2023 lows in the spotlight, but the breach will likely need a strong catalyst. Now, as long as the Aussie is above the 200-period EMAs, it is a driver's seat and has the ability to extend its gains towards 0.6860, but does not inspire confidence for more and for challenging the broader 0.7, 0.717 region. So now that's pretty much it on the analysis part, and let's look at what is ahead. As we said, US President Biden is meeting with congressional leaders for talks around raising the debt ceiling. Treasury Secretary Yellen had said recently that money could run out in June, early in June, which is much earlier than previously thought. Now, this theme has not weighed much on markets at this stage, and the truth is that there is some posturing there and some politics going on always, but it's hard to see to actually not reach an agreement at some point, and there is still time. But as long as an agreement does not come, then this could create fear in the market. Now, on Wednesday, we expect US CPI inflation The previous figures had shown a tick down to 5% for the all-inclusive reading and to 5.6% for core, and an increase, in core to 5.6. Inflation is elevated, even though it has been cooling, and the process of bringing it down to 2% has a long way to go, according to Chair Powell. So this data will be critical for the Fed's decision and could affect Wall Street, the US dollar, and other assets. Now, on Thursday, we expect the Bank of England, which started tightening all the way back in December 2021, and seems to be reluctantly hiking recently, while remaining non-committal on the next steps with vague rhetoric. However, the cost of living is very high, and inflation stayed above 10% in March, which will likely lead to further tightening. We also expect updated projections and press conference by Governor Bailey. We will discuss the outcome on our next session. Now, also on Thursday and before our next session, consumer and producer inflation from China are due. The last figures have pointed to weak demand, as CPI posted the smallest increase since September 2021, and PPI the biggest decline in nearly 3 years. There is some discussion going on here as to whether China's recovery is losing momentum or we're going to have a sluggish recovery. The last CPI and PPI data had pointed to a sluggish rebound. And other than that, we also expect earnings from various companies, of course, but I will be focusing on entertainment giant Disney due on Wednesday after Wall Street close. Its streaming services have more subscribers than Netflix for a while now, so can it stay ahead? How is that supported tier doing? The cost-cutting and restructuring plan that it recently announced, is it progressing? And where there'll be any comments around the feud with Florida Governor DeSantis? Definitely many things to watch out for in the Disney earnings report. So that's it from me. Thank you for joining me, and we will talk again on Thursday, and we will comment, of course, on the CPI figures and on the Bank of England outcome.